SMB Investor with Nick Bryant and Sean Smith.
Hey everyone, you got Sean Smith here, Managing Partner of Search Fund Ventures, and this is the SMB Investor Podcast. Today I've got Zach Pavlosky with me, and he's going to talk to you a little bit about the world of debt, how these transactions get financed, and what you should be focused on as an investor. So Zach, I'll let you kick it off and give a little background on yourself and your firm, and we can go from there.
Thanks, Sean. Appreciate you inviting me to the podcast. Quick background on me, and then I'll shift it over to my firm, Cerebro Capital. I've spent the last decade plus doing lower middle market investment banking, helping a lot of business owners sell their business, helping other larger businesses and even sponsors buy businesses, so working on the buy side as well. Then these last few years shifted more towards the capital advisory component of transactions and mergers and acquisitions, so helping companies and sponsors raise capital, both debt and equity, but primarily debt capital. And the firm I'm with today is Cerebro Capital. We're a tech-enabled capital markets advisory firm. So we have a patented application that just helps borrowers that are searching for debt capital and financing any number of things, find that right lender that has the right structure for them. Primarily today, cash flow businesses or cash flow financing of businesses, cash flow financing for sponsors looking to acquire businesses. That's primarily where I lead a lot of our efforts. Over the past 4 years, since 2021, help finance $850 million of acquisition loans. So the buying of businesses, primarily smaller businesses with below 10 million.
That's great. And maybe just help folks understand a little bit kind of where Cerebro and where you sit vis-a-vis kind of SBA lenders and then direct lenders or SBICs. What does that whole ecosystem sort of look like?
Yeah, our ecosystem is one of, so with Cerebro, we have about 2,300 lenders that we've diligently cataloged and understood, what's their approach, what's their credit box, what's their lending criteria. And some of those are SBA lenders, Live Oak being a very well-known example in their kind of SBA lending process. But then a number of them are going to be conventional bank lenders and then even non-bank lenders. Non-bank lenders have grown quite drastically over these past several years, just kind of blossoming from the great financial crisis of 2008, 2009, when banks were basically forced to pull back on a lot of lending. And then so these non-bank lenders have really popped up and kind of filled that gap, especially around acquisition financing. So within the world of non-SBA, you can think of banks that they're going to look for a specific type of borrower profile, specific type of credit profile. With the world of SBA, as we know, there's going to be limitations around that particular product. It is a really fantastic product, but there's still going to be limitations around it. Some of the bigger limitations, the personal guarantee, the specifics of rolling equity over to other sellers, the individuals on the cap table that might have to guarantee the loan itself, and just even the capacity, the limitation, the amount of debt that you can actually pull through to an SBA 7A product. So a lot of our lenders will consider SBA, especially the bank lenders or even the SBICs, they will consider SBA type products, but then a lot of them are going to have their own types of lending products as well. So there's always going to be pros and cons of both of those. And that's part of Cerebro's job, is to kind of give the borrower or the searcher optionality, understanding, and we work with plenty of SBA lenders as well. So can kind of go down the path of exploring both SBA options as well as non-SBA options.
That's great. And so you say you target companies below 10 million in EBITDA. Is there sort of a minimum that you guys have? Will you not go below 2 million in EBITDA, for example, because then that starts getting more into the, purely the SBA realm, or what's kind of your sweet spot, I guess?
Yeah, so since we do SBA, we have a gentleman on our team who speaks SBA incredibly well and can navigate that process. So happy to take a searcher through a process of exploring SBA and non-SBA options. So with SBA, yeah, you could typically think below that $5 million like loan threshold. EBITDAs could be 500,000, 600,000, 750. So perfectly okay working with them. As you think of then going towards more conventional lenders, whether it's bank or non-bank, they're typically going to want to see EBITDAs of a minimum of $1 million, and then scaling up from there. So plenty of banks, will absolutely consider businesses EBITDA of $1 million. And so you think about a 3, 4, 5, 6 times purchase multiple on top of that. So then you're looking for, loans of, $3 to $4 million, and then scaling up from there again. I would say primarily a lot of the deals that I work on tend to be a little bit larger in size. So minimum EBITDAs, probably 2 or 3 million. That's where you see a lot of those SBICs and non-bank lenders starting to get really interested from there. But I would say, from a loan size perspective, we'll consider placing loans anywhere a minimum of 2 to 3 million and then scaling up. We've done, 70, 80, 90, $100 million loans in our past. And the last thing I'll say on that, Sean, is it can be very industry specific too. We're very lucky to have a diverse set of lenders within our ecosystem and in our database. But some lenders are going to be a little bit more preferential to, asset light businesses or more asset heavy industrial businesses as well. So that can even dictate size requirements based on loan size as well as even minimum.
Sure. 2,300 lenders, that's a pretty sizable network. Do you have any sense of, the breakdown between SBA versus, regional banks versus SBICs for people investing in this space, that there's sort of a dead zone between the million to maybe just under $5 million in EBITDA, where it's pretty hard to find bank lender. The SBICs might be a little more aggressive. So if you were to say, you've got a really great network of SBICs and kind of regional banks, that's a pretty unique network to bring to the table for a lot of sponsors that are looking for funding. So do you kind of have that breakdown?
Yeah, it's about out of that 2,300, it's almost 50-50 banks and non-banks. But you can even think of, out of those 2,300, some of them are going to be non-active. Some of them are only going to be looking for, a deal criteria this big. So they'd be lucky to see one deal from us throughout a given year. And along that note, we'll probably facilitate anywhere between 150 to 250 transactions in a given year, just based on the kind of capabilities we have to do a large volume of transactions. But to that point, I would say out of the non-bank lenders, you're right, you're looking at a ton of those SBIC firms, and some of those will even entertain a pretty unique structure as well, that they'll entertain investing equity alongside of the debt. That can really help a searcher that might be looking to raise both debt and equity to get a deal done. So they're obviously talking to lenders, they're obviously talking to, equity investors as well, family offices, higher net worth individuals, qualified funds like yours that are targeted towards searchers or independent sponsors. But then you can also find some equity capital from some of these SBICs, which could be really beneficial in a search process as well.
Yeah, we're seeing more and more that, the lead kind of capital provider as a whole is, an SBIC, because they come with a substantial majority of the capital through debt, through acquisition financing. And then they'll also have some type of kind of equity kicker structured, whether that's the same kind of preferred equity that other investors are coming into, or a similar structure. So that seems like a trend that's just continuing, that we're seeing more and more. Is that fair?
Yeah. And with the cost of capital rising a little bit, combine that with the amount of inflow some of these SBICs are getting. They were a very low-key secret several years ago, and now all of a sudden they're becoming a lot more prominent lenders. They're raising, larger funds, et cetera. They're really interested in structuring a deal that incentivizes them over the long term to participate. Maybe it's growing alongside a sponsor, as that sponsor maybe gets another deal done, or even a searcher kind of transitions more into an independent sponsor structure. These SBICs love to be able to scale with an individual or with a group of individuals. And so one of the best ways they can do that is to have that equity participation, like you said, alongside some of the debt that they're deploying.
Makes good sense. You made a comment earlier that I wanted to click into a bit, about some of the lenders in your network have varying criteria, whether it's for size or for industry. Would love to understand if there's kind of a typical industry that a lot of the lenders in your network are interested in and would kind of say, yeah, this is a great fit. And then on the flip side, if there's any kind of areas or any kind of qualities of a business, whether it's revenue volatility or things like that, where, 90% of your lenders would say, hey, this is not going to be a fit. But maybe there's a few in the network that say, we can potentially get comfortable.
Yeah, sometimes you get so focused on like the quantitative aspects of raising capital, the EBITDA, the leverage, the purchase price, the ROI, the IRR from the investor perspective. But then some of those quantitative characteristics do matter, like industry, for example. Industries or business models that support a large amount of recurring revenue, those are going to be particularly attractive as lenders are looking at underwriting the worst case scenario, that recurring revenue or even reoccurring revenue, where it might be longer contracts. They might have to go and renew those contracts. Even as you move down from recurring in the most predictable revenue to non-recurring, the most unpredictable revenue, even like project-based revenue where you have a customer tenure of 12 or 22 years. So that customer keeps coming back, even though it is billed as project-based revenue. that's always going to be a little bit more attractive and easier for a lender to underwrite. So some of the business models or industries that you find that in are going to be the services businesses, so critical services, home care services, healthcare, even industrial-based services as well, so commercial and residential services. And those are typically ones where you find a lot of searcher activity. We've done a number of commercial roofing deals, HVAC deals, the plumbing deals of the world, commercial property management, HOA management. Those ones are becoming very common. Within the healthcare world, lots of, and you need a little bit more, kind of specific, maybe even operating experience as you move into healthcare. Med spas, even payer services are very common now. Medical device servicing, laboratory servicing, those are all becoming particularly interesting industries. But then you move to more the asset-heavy industries like manufacturing, precision machining, specialty distribution. Those are still going to be particularly popular among searchers and even independent sponsors. And underwriters are used to those more like asset-heavy businesses as well. And even some of the asset-based financing lenders are very comfortable with those because there's a lot more assets on the balance sheet. Then the last thing I'll say is with technology. Technology is one of those ones that is funny because you have IT services, you have managed services providers. Those fall within that like business-to-business services category that are still particularly easy to understand. And a lot of searchers are interested in those, especially if they come from a more technical background. But then as you navigate more towards like tech-heavy software, SaaS and stuff, it's not to say that there aren't many of those. And we have plenty of venture debt providers that work with those and can really understand the intricacies of a SaaS-based business. But then you also do have a lot of lenders that just don't really play in that software space, even though it can be an incredibly interesting model. There's clearly good tailwinds in the industry, but you got to be careful as you move more towards tech. You have the tech-enabled businesses that, again, are still particularly interesting from a lender perspective and more easy to underwrite and understand. But you start getting too techy and you start moving into that more software and SaaS world, you might have some lenders starting to throw up their hands and say, look, that's just a different model than we're really familiar with and stuff for us.
Very helpful. So if you had a company that's, say it's an industrial business like an electrical contractor or a plumber or something like that, but they're primarily kind of new install project-based revenue, and maybe they've got a decent amount of customer concentration, call it 30 to 40% in the top 5 or so. How hard is that going to be for you guys to get a lender for? Or is it even feasible?
Yeah, not impossible. I will say that. And you touched on a good point going back to the customer concentration. It's typically on a case by case basis, but when you start seeing one, sometimes even two customers become 20, 25, 30% of the revenue in a given time period, that's when lenders start to raise some red flags and start talking to the borrower around, are there any ways to mitigate a potential issue there with, having 20, 30% of your revenue leave for any number of reasons, high amount of risk there from a lender perspective. But when you come to, it's important to understand searchers too, because a lot of times searchers will have a background or they'll have some sort of like experience with shifting more from project-based revenue to trying to install a recurring revenue model. Now, easier said than done, and there's always needs to be like a well thought out game plan for that, and lenders are definitely going to want to understand that. But as you might think of that plumbing example, is how can you get customers involved in maybe maintenance contracts? So where there is that recurring revenue, selling, for lack of a better term, subscription packages or kind of annual servicing packages that do have that recurring amount of revenue. Seeing plenty of searchers and independent sponsors undergo that type of operating game plan going forward. And lenders are going to want to particularly understand that. And if there is an opportunity to maybe scale alongside of that recurring revenue, they will consider that. But you obviously can't underwrite what isn't there today. So if that is the plan, really, really diving into that with a lender and helping them understand that will potentially help to bridge some of those, disconnects around underwriting what's there today and what might be there tomorrow.
Great. So if you had to take, the qualitative industry commentary you gave and that kind of specific feedback on some of the challenges, couple that with, the quantitative stuff like the credit metrics and the, revenue and EBITDA, volatility, margin, all that stuff, what would be just the ideal company profile? If it came across your desk, you'd say this is a slam dunk, and I'm sure 99% of the folks in our network would want to be a lender to this deal.
Yeah, from the financial side, it's going to be minimum EBITDA, probably closer to 2 or 3 million, and having a history of showing that as well. If you were at EBITDA of 500,000 last year and all of a sudden you're up at 2.5 this year, some questions will be asked, especially if there wasn't like revenue there to go along with that. We've seen certain instances where a seller was positioning their business to sell. And so they go through a cost-cutting exercise or they find a way to trim some of their OpEx. Understandable, but an underwriter is going to look at that and did they reduce too much of their expenses to support the business and support growth opportunities going forward? And that would be a red flag in particular. Good history of growth of revenue, while underwriters aren't, it's usually more the equity guys that are interested in growth. But lenders too also want to understand that there is some sort of predictability to the revenue, whether that goes back to recurring revenue or just a pattern of growing the revenue is also helpful as well. And then qualitatively, yeah, like exactly what you had mentioned and what I was talking about as well. Sticky customer history, solid kind of core management team. If you're the searcher stepping in and going to become the executive, great. If there's other key members of the management there, also incredibly helpful to know what is your operating background as well. That helps a lot of these lenders, either bank or non-bank lenders, understand what your ability to operate the business is going forward. And then in industry, customer concentration, those are big ones nowadays with talks around some of the macro things like tariffs. How are you sourcing your business? Are you exposed to some of these bigger macro things? That's something that lenders are starting to understand or needing to understand just based on what's going on. And so, yeah, all of that's going to be a combination. And that's why lenders' jobs aren't always that's why they typically will spend more time pre-diligence or pre-term sheet as well as post-term sheet, just understand all of these things to really be able to underwrite the business and provide attractive terms.
Got it. All right. So not peak earnings, steady EBITDA, steady growth with the right story around it, and then the right quality of revenue and kind of industry dynamics that aren't a cause to say, hey, if one customer leaves, we're going to lose all our revenue, or this industry is highly sensitive to discretionary risk or cyclicality, things like that. That's kind of the lender checklist, if you will.
Exactly. Yep.
Awesome. So now shifting to the equity side of things, right? I think a lot of folks underwrite deals very similarly, right? A lot of the equity folks, at least in this space, are looking for that high quality of revenue, stable earnings, enduringly profitable sort of profile for these businesses. But, equity naturally is second priority to debt, and that the compensation for that is there's a lot more upside if things go really well. So you've also paid more attention to underwriting these upside cases to some degree for equity folks. But on the downside, there's various ways that companies can come into a bad position with their lenders, right? And it's not just if they miss an interest payment. Especially in the SBIC world, there's covenants in the documents in most cases, right? So maybe talk a little bit about what equity investors should pay very close attention to as it pertains to kind of the loan terms or the acquisition financing terms that could impact how they think about the risk of their investment.
Yeah, you're right. It has to be a harmonious situation between the lenders involved in a deal and the equity investors, the shareholders in a deal. So what I've seen in my past experience, equity investors want to understand some of the covenants, like you had alluded to. That will be part of a loan package. So negative or even affirmative covenants. So a good example of a negative covenant is like a leverage ratio. So if an equity investor, even the searcher, anticipates, growing through acquisition and financing those acquisitions through some sort of debt, needing to understand what the leverage profile, what the leverage capacity is as that senior lender, and might have certain covenants around, again, how much leverage they can take on. What are the reporting requirements? Is it going to be overly burdensome to work with this lender, and therefore maybe it cause some friction around how quickly the business can grow, whether organically or inorganically? And then even just thinking through what is their non-debt participation, equity participation from the lenders in the form of warrants. Is it convertible debt? Is it preferred equity? Is the equity or the common equity investor going to get diluted through some sense? Or are they going to sit even further back in some sort of capital priority, whether it's preferred equity coming in front of them or, again, some other sort of equity instrument? So all of those are just keen to look out for as you're investing alongside a searcher. And a lot of times it is good that equity investors have good relationships with a lot of these more well-known lenders. I used Live Oak as an example earlier, but even some of these SBICs, not as they're just investing equity as well, but the equity investors like yourself and your fund, you're going to be very familiar with these SBICs and what their more common type of structure is. So all of that, like you said, it's got to be well known. The searcher needs to be on the same page with both the lender as well as the equity folks to make sure that there is like successful long-term alignment.
Yeah, no, that's a great way to put it. I think the relationship needs to be harmonious. And, we pay a lot of attention to governance between the sponsor and equity investors and what minority protections are, what the board's rights are. But to your point, it's also really important to understand, well, what are the governance provisions in the creditor agreement potentially? And how can that impact what equity investors might see in a less exciting scenario, right? Very good. Well, any war stories you can share? Any scenarios where you've seen either technical fault or covenants tripped and how that's played out for both the creditors, the equity holder, the sponsor, just everyone? Yeah.
Yeah, I'd say a couple of things on that. One, yeah, post closing, you have the acquisition. You're now the operator of the business. The searcher's really focusing on day to day and less on the closing of the deal and capital raising. Just making sure as you continue to operate the business going forward, keeping that lender relationship warm and friendly is always a good thing. No one ever wants to think about the worst case scenario, but I was talking to a lender, maybe a venture debt lender or a lender that has a little bit more of a, interesting junior capital structure, financing more tech-enabled businesses. And one of the things that he pointed out to me, and obviously this is something that you as the searcher would do, diligence, you're exploring lenders as well. The lender kind of talked about how willing they are to work with a borrower as things maybe go sideways, whether it's an interest holiday or something like that, as the business maybe goes through a tough patch. Again, always be willing to not just understand that, but make sure that the loan docs and the credit docs actually verify that. But just understanding that from a lender perspective, typically non-banks are a little bit more flexible when it comes to modifying covenants or some sort of go forward modification of the original credit docs. Banks, maybe not so much, not to say that it's unheard of. And then the other thing I'll say is good education for searchers is just to really think about how much is realistic leverage when it comes to financing some of these acquisitions or some of these buyouts. And it's so great to have good relationships with equity individuals like yourself and others out there that are really focused on investing in searchers and sponsors, because sometimes a searcher will think that if the SBA will give me 90% leverage, then I'm sure bigger banks like a Citi or Wells Fargo or even a regional bank, that is usually 99% not the case from my experience. So just being very realistic with how much leverage can you get, what that timeline might look like for you to raise additional equity. And then again, going back to what we had talked about is, can I use some of those unique equity providers, whether it's SBICs, whether it's, family offices that are focused on supporting searchers and sponsors, can I leverage them in my search to get a deal done? It's perfectly okay. At least in my opinion, as I've seen these searchers, it's perfectly okay. If you can find extra equity right now, maybe you want to take that, even if it, hinders some of the returns that you've modeled out. Maybe look at taking that extra equity on right now and saving that leverage capacity, saving that debt for future opportunities, whether it's buying another business, undergoing a roll-up or inorganic growth strategy. Maybe think about taking that on right now, because again, banks are very keen on that. Non-banks are also very keen on what that ultimate leverage is going to be. And you just don't want to be stuck as a searcher having to potentially walk away from a deal just because you didn't think about what the optimal capital stack between debt and equity is from the get-go. And I have a ton of those pre-LOI conversations to help a searcher understand that and the trends that we're seeing.
That's great feedback for folks. Yeah, always better to, take the capital when you don't need it as much than to be begging for it when times get tough. Very good. Well, anything you want to leave us with about kind of, Cerebro or yourself?
No, again, I've worked with so many searchers and sponsors in the past. It's a business model. It's a cohort that I know incredibly well. We do a ton of those types of acquisition financing deals through Cerebro. So always willing to help be a resource to anyone that I can be. And just, appreciate the time, Sean. Really looking forward to this. You've been a great partner to me and some of the searchers that I've worked with. So just appreciate the opportunity to chat more.
Awesome. Likewise, Zach. Well, thanks so much. And look forward to continuing to be a good partner.
All right. Thanks, Sean.